webinar is being recorded.
Hello, good morning, everybody. Thank you for joining our monthly webinar. What a day yesterday it was in the markets. Massive movements in a lot of stocks. The S&P 500 was down more than 2 to 3%. The Nasdaq was down about 4.7%. We will discuss all of that and more. And let's just get into it. Sunil will start discussing about the US macro, and then I'll follow with a little bit more detailed information of what's going on in the AI space, because that's been a large theme and a large discussion point of lately. So having said that, let's start. Sunil, the floor is yours.
Thank you. And I know it's a very interesting day to be doing this conversation. I don't know whether Ketul spoke to somebody up above in the US to actually trigger this, because I think it's obviously that this portfolio is all about AI, and what happened here was the AI shock. We will discuss that briefly, but first let me set the macro context. So can we just go to the first slide?
Yes, I have shared the slide. Sunil, go ahead.
Can you hear me now?
Yes, we can.
Yeah. Oh, in the middle went off. So, like I said, the war remains an uncertainty, but the positive news is that oil hasn't breached the 95 to 97 mark and gone into the hundreds and the 110s as it was earlier. And it is at a kind of, I would say, consolidation zone, if I may use the word, as far as oil is concerned. And it's on a day-to-day basis, what Mr. Trump tweets or what happens is by and large being taken into consideration by the markets without a strong reaction, right? So then when we come to the core economic data, the non-farm payroll got released. And this was a huge thing because it came in at double the expected consensus. So it's a huge, so clearly it's good for GDP growth in the US economy, what's coming through. And they again revised the April and the March numbers also very healthily to 1.8 lakh as well as 2.14 lakh. So it's good for GDP growth, good for broader macroeconomic fundamentals, but obviously from a rate cut perspective, we'll discuss, this is not really positive from that. And the fact is that the oil being stable at around mid-90s, followed with a strong growth rate, it means that S&P 500 earnings are still expected to grow at about 22% in calendar year 26. There's no big change in that number. So the next slide. Right, and you look at it, Asia, because of the semiconductor rally in both in Korea and Taiwan, obviously led the charts in the month of May. But it's basically the AI supply chain and the hyperscaler-led investment demand which has driven the rally in this particular month in these markets. You can go to the next slide. Right? And like we said, by and large, energy inflation should start getting some base effects soon, as not from a year-on-year basis, but at least sequentially. And you will see that April CPI, which rose to 3.8, while core remained at 2.8. But while the energy shock has complicated the disinflation process, right, some of the impact may prove temporary if oil price continues to moderate, right? So like I said, that's something that's a trend line that we'll keep tracking. But in terms of the Fed, it remains the biggest constraint for the new Fed governor to do a rate cut immediately. Clearly, that's going to be a constraint. The next slide, as we move forward, right? We spoke about this non-farm payrolls scaling very strongly, and the Bureau of Labor Statistics job openings and labor turnover, which is called the JOLTS, right? Posted 776 million job openings in April, 731,000 up from March, and highest since May 2024. So basically, labor demand rising is the best news we have in terms of the US markets, right? And there's a 3-year downward trend following the 2022 peak, which has now been reversed. Right? But now the bad news is built in the stock prices because US inflation data has been in the markets for some time now. And markets for now, it is given any hopes of Fed easing this year. And there are growing expectations of a rate hike. Depending on every day, this rate expectation changes for October as well as December. But as of now, you can say on a weighted average basis, a 16 basis points rate hike, which represents a 65% chance of a 25 basis hike by the end of 2026 is what the market is factoring. But remember, this could change very fast both ways. But any deal with Iran, which is more likely than I would say escalation with Iran, but we are not Donald Trump to really sit and decide that. Could be a major catalyst. But anyway, whatever it is, it's a near-term challenge which could go away. That's just what we want to keep in mind here. So going ahead to the next slide, right, is that the price of gas is high, but the consumption is not hurting. Because if you see the price of gas as a percentage of US wages, it's not very high compared to the historic levels. The graph on the right-hand side clearly explains this. So the jagged graph that you see, right, that's the actual gasoline prices. And what is there is the middle line that you see, right, is the growing average and the plus or minus one standard deviation, right? So you can clearly see that gasoline as a percentage of wages is nowhere near the previous peaks which the giants represent, right? It's closer to the valley than to a peak. So which means that while in a public opinion poll, a customer will complain about gas prices, both in terms of Mr. Trump's popularity as well as when the inflation expectations are asked for, but practical buying behavior of the consumer is not hurting. He is not seeing that as his willingness to spend, right? Because as a proportion of the wages, it's still very, very reasonable compared to the historic averages. So I think that's a positive to take away from, right? So, and what the war has done has actually helped the US to consolidate its grip on global trade. US is still dominating global trade. You can see that the payment share, dollar is boasting the payment share, US dollar share of international transaction via SWIFT. So for all the talk of the de-dollarization and all that was happening, which was giving gold a big boost in terms of its rally, while it's a fact that central bankers have been accumulating gold, the fact is on a practical matter, when you come to transaction volumes, as seen from the SWIFT platform, the dollar continues to be the dominant currency being used there. In fact, it has sharply spiked post 2023-24, and now we are seeing another spike up. So the US dollar, as opposed to the US country, the US dollar still dominates global trade. And earnings growth, there is no let up in that. Solid 22.6% EPS growth is expected in the current year. So we know that the market reacts to specific stocks in the AI space, but if you take the 500 stocks in the S&P 500, overall, 22% EPS growth. And mind you, India is struggling with that kind of a growth. We're supposed to be the fastest growing economy in the world. And look at the rate that the US stock market is posting. Because remember, the US stock market is not just about the US economy. A lot of companies there derive their earnings from the rest of the world too. So the US stock market earnings are for now at a very, very healthy 22% EPS growth for the current calendar year. Right. So yesterday's move now, let's address the elephant in the room, right? Yesterday's move, the first line talks about the jobs which you spoke about, which has eliminated the chance of a rate cut, right? And a higher probability. Naturally, as a reaction, the market is pricing in a higher probability of a rate hike, which a rate hike is always risk off, right? So that's one thing which caused the market swing. So the new federal chair was appointed to cut rates. That's what Mr. Trump's clear ask was. But unfortunately, the data today will not support that. So pretty much I can say that a rate cut is ruled out. And that was probably a trigger for the news yesterday. Apart from which, the numbers were actually quite decent. I didn't see anything, the numbers that could have caused this kind of a crash, right? There was news around the fact that, oh, Google is now diversifying to another supplier and all of that, which had led to. But if you look at the projections of the company itself, were very, very healthy and robust. So I don't think there was an issue. So I think it's best to look at this as a technical correction caused by a strong recent rally, right? When there is some what you call profit taking, some catching breath, that type of thing. I think that's our perspective here. That ultimately earnings growth, a strong labor market are all good news for the economy, and the AI hyperscalers as well as the chips and all of those. I think while the market may have had a very, very lofty opinion of the kind of growth rate they should show, and there will be natural disappointment because you can't perennially be growing at 30-40% per annum in that way. So even if a 30% annum comes in as a 25% growth, market gets disappointed because that's what's priced in. So this will happen. And very often we have seen that in healthy bull markets, right? Which, because that's the heading of our webinar, we believe AI is the fourth industrial revolution. So the kind of things it can unleash in terms of potential for the economies and the industries of the whole world, taking away your impact on the IT sector for at the time being, overall, the kind of productivity improvement that AI can bring in, all of that means that we are going to look at a completely new set of growth numbers and expectations. And so one should only look at these kind of corrections, as I said, just catching breath, and we should look at these as good investment opportunities in a diversified portfolio, which takes cognizance of AI's impact on the markets and the economy, right? So in conclusion then, the next slide, right? What are the things that are in data in front of us? Robust labor market, we discussed that. Consumer resilience, we discussed that. Dollar's continued dominance of the trade world, we discussed that. Unprecedented corporate earnings, S&P 500, 22.6%, which is that. Inflation is the wild card. While it's a percentage risk, we do hope that a geopolitical resolution of the war could ease that. And so then that's a question of when and not if. And finally, given these structural pillars, a credible bear thesis is difficult to justify. It's only that we have to look at any such corrections as a bull market correction. And so staying invested through this process is probably the best from an investment perspective, right? So with that, I'll hand over the floor to Ketul. I'll be here available till 11 o'clock. I have another engagement at 11. So if Ketul is able to finish before 11, I'll participate today. Otherwise, Ketul will take care. Right. Thank you.
Thank you, Sunil. Thank you very much.
Not 11.
Yeah, noon, I think.
Noon. Yeah. Go ahead.
Thank you. So yeah, I think if you were surprised by yesterday's market move, you are probably not alone. You have company. This was Donald Trump's tweet yesterday. With a great jobs report like this, theoretically the market could go up, but that did not happen. So yeah, I think as Sunil rightly explained, this was more of a good news is a bad news type of a reaction because this almost eliminates the chances of any rate cut in the near term. So market was disappointed with that, and that's why it sold off. There's no fundamental reason apart from this that the rate cuts won't happen. So that was the only reason why the market sold off, because now for 3 months, job numbers have been great. These are not good job numbers, these are great job numbers. So the chances of a Fed rate cut goes pretty much to zero. And that's what the market was crying about. It's more like market crying about something rather than market worried about something. They wanted more. Always, markets always want more from the government, from the Federal Reserve. And it seems when the economy is doing really well, you're not going to get that. So that was the market getting disappointed primarily. And obviously, Donald Trump is also disappointed that with such a great job numbers out there, the markets should do well, but they corrected yesterday. So don't worry if you were feeling a little bit surprised. You're not alone in understanding this market's reaction. So let's move on. Now, these are some of the questions that we frequently get during the month, so we want to address them head on. A large part of our portfolio is exposed to AI, at least 30 to 40% of our portfolio, maybe slightly more also, is exposed to the AI stocks. And so this is a very pertinent question, that is AI in a bubble? And the chart on the right-hand side shows you what happened to Cisco. And Cisco and NVIDIA are comparable. Cisco was the darling in the dot-com boom, and NVIDIA is the darling right now. So if you look at their earnings growth and the stock price growth, you will see the blue line in the Cisco chart on the top chart. That was the share price. So the share price went up without the commensurate growth in earnings. And whenever the share prices go up without the commensurate growth in earnings, we call them a liquidity rally. And that liquidity rally, one day or the other, it does stop. And that stopped for Cisco in the late 2000s. And that's why the stock crashed. But if you look at the chart at the bottom, which is the AI leader right now, NVIDIA, a comparable company because NVIDIA sells AI infrastructure. And similarly, Cisco was selling internet infrastructure in the tech boom. Both of them are hardware companies. If you see, it's the exact reverse. In fact, NVIDIA's earnings have grown much faster than their stock price for the last 3 to 4 years. And that's why we don't feel that comparison is a valid comparison, or that we are anywhere close to the dot-com bubble, because the earnings growth is much better than the stock price growth. So if anything, it should be the reverse. If this earnings growth continues, then the stock price has to catch up with earnings. And that is where we are. We are feeling that earnings growth is outpacing the stock price, and the stock price will eventually catch up. Will it catch up next month? Will it catch up 6 months? That's the question that we are trying to understand. Obviously, we don't have a crystal ball, but we do feel that the stock prices should catch up to earnings, and NVIDIA should move higher from here. So that's a big difference. AI is definitely not in a bubble based on the earnings that you see right now and the stock prices. So then, where is this earnings coming from? Right? That is the next question. So the earnings that you are seeing for these companies like NVIDIA, they are coming from primarily from increased usage of AI. You will see the token usage, which is every word that AI generates is a token. So the token usage is growing 13x year over year. In the last few weeks, it has grown by 13x on a year-over-year basis. So you are not talking about a slowdown in AI usage. You are not even talking about a maturing of AI usage, because that's when you talk about percentages. When we talk about AI token usage, growing year over year by 5%, 10%, 15%, that's when you are getting close to maturity. We are not even talking in terms of percentages. We are talking in terms of X, right? So the token usage is growing by 13x year over year. And so we are nowhere close to maturity. And that's why we do feel that the earnings that these companies are showing, they're likely to grow, not only sustain, but likely to grow. Because when you have the underlying demand usage of tokens growing at 13x, you are far away from maturity. So that's why we are not worried about that. So that is what we are seeing right now. What is the future expectations? The expectations are that token consumption will grow by 24x from today. So you are already grown 13x year over year. The expectations are that the token usage will grow by 24x between now and 2030. That's a huge number. Again, we are not talking about compounded percentages. We are not talking about 24% growth per year. We are talking about 24x growth between now and 2030. So when you have such growth numbers that are being expected, I don't feel that there will be an issue with earnings for these companies in the near term for sure, because the underlying growth is continuing. So then the next question is, okay, these assumptions are made by Goldman Sachs. They could be wrong. Absolutely, they could be wrong. Can those numbers grow by 24x over the next 5 years or 4 years? So what are some of the points? And there are 2,000 points that we can provide, right? But all that is historical data. What you need is some indication that this growth is going to continue. And that's why we looked at some of the skeptics. Okay, when you are using on a day-to-day basis as a consumer, we haven't started using AI to the level where we will be using in the next 2-3 years. So as our usage grows, definitely the number of tokens will grow, right? What I was using AI 1 year back was a lot less than what I use today. So my own personal usage has probably gone up by 10x, and that everybody will see that usage growing. But some of the we take an example of Ken Griffin. He was one of the biggest skeptics of AI. He's the founder and CEO of the largest hedge fund, Citadel, in the largest hedge fund in the world. And so he was one of the biggest skeptics. At the beginning of the year, at the Davos, World Economic Forum in Davos, he said that AI was all garbage because it looked cool on the surface, but when you try to do anything meaningful, it was just not giving the responses that he was expecting. This was his view at the beginning of the year. Now, earlier this month, he was at a conference where he said that in his own company, AI is doing work which could be done by PhDs. Over weeks and months. Now AI is doing it over days and hours. So this tells you that AI is not fluff, which we did feel at the beginning of the year. Now AI is really maturing, and the use cases for AI are really growing, where now AI is replacing the work done by PhDs. So now they are attacking the white collar market, which is about a $40 trillion annual market. So you can imagine AI is trying to replace $40 trillion worth of labor market. Obviously, it won't replace all of that. It won't replace even a fraction of that. But you can see why people are so interested in investing in AI. And the reason that you're seeing the growth in tokens is because it's improving. Between the beginning of the year and now, which is 6 months, AI has improved so much that Ken Griffin changed his view. That tells you that if you go 2 years from today, the amount of change that you will see in the maturity that AI has is just going to be phenomenal. It is changing every day as we speak. And the use cases just keeps on growing. And amongst us also, we have just started using AI. We are not using AI apart from search or maybe generating a few reports here and there. So as we get into the depth of AI, add more and more use cases to our daily lives, the revenue generation potential, the usage potential of AI will just keep on growing. So there is real proof that that the demand is growing. So we are not surprised when they say that the token usage will grow 24x. And so obviously capital expenditure follows. We are expecting, or rather the market is also expecting about $800 billion in Capex in 2026 and $1.1 trillion in Capex in 2027. 1.1 trillion with a T, it's not a B, right? That is the Capex expectation for next year that is going to be spent on AI. Primarily, 60-70% of that goes to semiconductors, which is chips and networking and memory and data transmission and racks. So that's huge. 60 to 70% of 1.1 trillion, more than 700 to 800 billion going to just the semiconductor space. And that's why these stocks are reacting the way they are reacting. As long as this number stays strong, we don't see any issue with the earnings of NVIDIA or most of the companies in that space. Now, will the markets overshoot by a little bit? Yeah, that's the nature of the market. It's never going to be a perfect straight line. The markets will overshoot, then they will correct, they will undershoot slightly, they will go back up. But as long as the underlying fundamentals are there, this short-term gyration will not matter in the long term. And that's why we do feel that we are in the first 2 years of a 10-year AI revolution. You are just scratching the surface, you are just starting. And don't worry about the 5-10% variations in the stock market that happen over a short period of time, because that's the nature of the market. You can't help with that. But over the long term, the trend is clear, the usage is growing. There are people who are willing to spend to continue grow that usage. So there is no doubt in our mind that this is a long-term trend, and we are in the first 2 years of a 10-year journey. So who are the builders? Google issued equity earlier this week to spend on building data centers for AI infrastructure for next year. So Google hasn't issued equity, just to give you context. Google hasn't issued equity since 2005. So after 21 years, Google is issuing equity for the first time, and they don't take such decisions lightly. Obviously, they do see the need for these investments, and that's why they are issuing equity. And it was well accepted in the market, and there's no issue with them issuing equity in the market because there's enough demand for it right now. And it did go through fairly easily. Meta is also expected to issue equity. There were rumors in the market that Meta is considering a similar equity issuance. I will not be surprised if Microsoft and Amazon come up with similar equity issuances over the next few months, because this Capex is absolutely required. They have order books in trillions of dollars. Last time I checked, combined between all three of them, they had a 1.1 trillion order book. These are fixed contracts for them to provide AI infrastructure services. This is not some pie in the sky. These are contracts saying that over the next 2 to 3 years, we need $1.1 trillion worth of AI services from you as in from Microsoft, Alphabet, and Amazon. These are the providers for third-party AI services. Meta does not provide services to the third party. Meta uses all of their AI infrastructure for their internal usage purposes. So that was on the Capex side. Now on the application side, who is leading? So far, OpenAI was leading. Last month was the first month when Anthropic took over OpenAI in terms of the number of businesses using paid AI services. The number of customers, or paid customers rather, that Anthropic had exceeded OpenAI for the first time since 2022, 23 when all of this started. OpenAI was the leader, but it seems Anthropic is now beating OpenAI in terms of number of enterprise users or business users. Now, this is important because there are some nuances to this because Amazon is a primary provider of AI, underlying AI infrastructure. So Anthropic provides the large language model, but to process those large language models, you need compute power, you need computers, servers, and data provided by AWS. Now, the difference between AWS and the other two, Google and Microsoft over here, is that Google and Microsoft, they ask for a fixed contract, which is like a rental. So what Google and Microsoft say that if you want us to run your models and run AI on our servers, you have to pay a fixed rental of X number of dollars per hour basis, and you sign a 3-year contract. So it's like you renting an apartment for 3 years. And then it doesn't matter. You can sub-rent it to somebody else, but Microsoft and Google will ask for a fixed amount of rent from you, irrespective of whether the business you are doing out of that apartment is worth $1 billion or $1 million. They don't care. It's a fixed fee that you have to pay as a renter on Google and Microsoft servers, and that's what you will pay. Amazon has a slightly different business model. What Amazon does is that, okay, I will rent the apartment to you, but I will charge a percentage of your revenues as the rental. I'm not charging a fixed rental. I'm charging a percentage of your revenues. So to Anthropic, that's their deal. They don't charge a fixed fee. They charge a percentage of Anthropic's revenues, which means Amazon actually does care whether that rental apartment that they're given to Anthropic, whether that makes $1 million or $1 billion. Because if that apartment makes $1 billion, they will get $500 million as rentals. If that apartment makes $1 million as rental, they'll only get $500,000 as a rental fee. So it's very important to understand this difference in business model, based on which, as long as there is huge demand, Amazon will phenomenally outperform in terms of margins, in terms of AI profits, because they are getting a percentage of revenues versus a fixed rental. So these are some of the nuances, new business models that are coming in, but we are looking at all of that. And you will see those differences show up in the market every now and then, when they're, especially during the earnings season. Now, then actually, is there enough returns to be made? Because all this Capex is being done, Anthropics, OpenAI of the world, they are generating tokens, everybody is using it. Are the charges good enough to generate profits? And the proof is here. Google's EBIT margins for the cloud business, not for the entire business, just for their business, which is AI infrastructure, has gone from 2.6% when the AI boom started to now it is 23.7%. In fact, in the last quarter, it has gone above 24-25%, if I'm not wrong. So these are actually companies generating huge profits and on large revenue basis. Google's estimated AI revenues are $80 to $90 billion in 2026. On that, they are going to generate EBIT, which is almost pure cash flow, of about $20 billion. This is real cash flow, real margins. So there is no concern about AI not generating returns or AI not generating enough margins. The service providers are generating massive margins. Some of the application providers like Anthropic or OpenAI, they may have to tweak their business model a little bit to get into profits, but their valuations are showing they're expected to go IPO at $1 trillion valuation. So there is no concern about them not generating enough revenues or margins. So that was all about AI. Now I'll quickly switch from AI to the general markets and why we feel that the general markets are not in a bubble territory either. So we first discussed AI, it's not in a bubble, why it is not in a bubble, the usage patterns of AI, how well the usage is going, how the margins are, who are the major players, who are the leaders. All of this we discussed in detail. And if you still have questions about AI, about its validity, take it up in the Q&A part. But now we'll move to the general markets, the S&P 500. We cannot stress enough that this S&P 500 rally that we are seeing, it is not, in upper caps, not a liquidity rally. Whenever a rally is based on actual earning, and that's the chart you see, the earnings and the stock price, the blue line is the S&P 500 stock price value, and the black line is the earnings growth. They are going in tandem. One is not growing faster, and whenever it has grown faster, it has come back down. So right now they are growing in tandem. And that's why this is a fundamental earnings-based rally. This is not a liquidity-based rally, a very important differentiator. And that's why we feel confident. And that's why we do take such chances whenever the markets go down by 2, 3, 5%. We take an opportunity to deploy our cash, to deploy our money that we have in the portfolio for buying stocks at a slight discount that we got yesterday. So again, it's not a liquidity-based rally. Another proof over here, you will see on the left-hand side chart, the red part is the earnings-based return. The yellow part is the valuation-based return. The valuation-based return is almost negligible, which means the valuations have not increased. The returns you are seeing so far is because of the growth in earnings. So this is a real true rally. This is not a liquidity-based rally. Right. Moving on to the next slide. So that was at the S&P 500 level, at the MSCI all country world level. Let's look at individual stocks. We have gone through this in the past, so I'll just quickly glance through them. But on the left-hand side top, you will see Meta's last 10 years forward PE multiple. It's fairly close to its 10-year low. On the right-hand side bottom, you will see Nvidia's forward PE multiple, fairly close. In fact, it's not close. It's at very close to its lowest point, which it reached in 2019. Its valuation has never been so low. And Nvidia being one of the darlings in the AI industry, its valuation trading at a historic low shows that how far away we are from a bubble. Similarly, Microsoft trading at fairly close to 10-year low multiples, Amazon trading at all-time low multiples, Netflix trading at all-time low multiples. So these are all the top magnificent 7 stocks which were in rally mode last year, and we are seeing that they are not trading at very high multiples. So there's no reason for anybody to worry about. So then comes the question, what does a bubble look like? So here's your visual on how a bubble looks like. On the left-hand side, you are seeing a chart of what PE ratios were for some of the top companies in those days. In the year 2000, you will see they were almost all of them were above 100. Some of them were trading in 600, 150 PE ratio levels. So this tells you this is what a bubble looks like. Right now, S&P is trading at a forward multiple of 22x. That's nowhere close to, and some of the large stocks that we talked about, like Nvidia, which is comparable to Cisco, it's trading at a PE ratio of 22, 20, 25. In that range, it has been trading. Cisco was at 148. So forget a bubble, you are far away from a bubble. And so we are not worried about a bubble at all. This is a very normal market. Corrections like this happen. It's a very normal correction. And there will be another 5 or 10 corrections that we can be assured that will happen over the next few years. So when you do get such corrections, it's the time to deploy money, not to worry about a bubble. This is not a bubble. These are some AI demand signals and all that. We will not go through that. And so I think before Sunil leaves at noon, I want to leave some time for Q&A. So let's start with Q&A. Suman, can you just assemble a roster of questions and from the Q&A box and ask those questions? I will go on a mute momentarily so that if Sunil has to answer, then the echo issue is not there. Suman, please ask the questions.
Sure, sir. So some participants wants to know that currently how it may, impact the IT sector and how, this war situation will go, like how far. So is there any, like point you see that it may come to an end?
Sunil, go ahead. IT sector, I think you probably have a lot more to say than I will have on the Indian IT sector. I'll go on mute.
See, okay. So first of all, there are two questions. One is the war and one is the IT sector. So see, IT sector in India, right, is got to be an AI enabler, right? It's obviously not a chip maker. It's not a hardware part of the AI. We are far from a semiconductor-driven country. So IT is the way the IT companies m- make a transition to AI consulting is to me what will drive the future of this. So far, there's been a lot of talk. All I can say is that whatever the Indian company, IT companies are saying to the analysts is not convincing the analysts. Okay. Now, the fact of the matter is, I'm sure all of them are working on AI. And in fact, from the AI data center part, the Indian future looks quite positive because we've declared a tax holiday till 2047, which is a very unusual kind of a step. And clearly, we want to cash in on that part of the boom. So those IT companies which do partnerships there and all of that would obviously get a new revenue stream from that part on there. Second is that we heard companies like TCS say that almost all of their top clients have asked them to bid for their AI restructuring projects of those companies, right? So I think that right now the market is still waiting and watching. There are no convincing answer yet. But that being said, I'm an optimist. I'm sure some of them will make that cut. Problem is to see who is going to make that big shift. Second is existing business models will be under stress. You saw what even Citadel's chief changed his mind, right? So the user industries, right? So IT industry as a SaaS model, as a SNP, what is it called, SAP, running 3-year, 5-year programs, all of them are probably going to lead to a slow death. But it doesn't mean that they will stop earning money overnight. So the point is, so to summarize it, I feel that IT has moved from a clear-cut growth sector, which it was in the post-COVID phase, to a value sector with investors who like good dividend yields, investors who like a dollar hedge, especially if you're in India. Those will find some value-based buying. So you saw that there was a sudden rally in IT, about 8% over the last 2-3 days. And then it's gave up that rally to some extent and started coming down. So it is a trader's market for me, and it's a value player's market, right? It's not a growth market. So can money be made of IT? Yes. But as an investor, I would say that I'd rather we put money on real growth businesses where we can see the line of growth. Today, IT is not showing that. I'm not the doomsdayer for the IT sector, but clearly I feel they must do a much better PR job when it comes to talking the large scale investors, so they don't stop, they stop selling it. That's where I'm on IT. On the war, does it look like end? Well, two dramatically different opinions. One is the inflation bit, which says that ultimately Trump will be under pressure to end the war with a declared victory soon. The other one says that he's not worried about the midterm election. He says he doesn't care about whether the war. He said somebody asked him till when it lasts. He said some date in September. I think some Labor Day or something. He said it can go on till then. So America's, I think some people are saying they're rebuilding their arsenal now and preparing for a fresh attack. So it's a very hard question to answer. But next 2 to 3 months, I'm not sure that Israel, for example, is no mood to give up the war. Hezbollah is in no mood to give up the war. We just have if whereby Trump can walk away with the victory comes up, but we need to treat the war as a short-term phenomenon and your definition of short-term to a few months instead of a few days.
Thank you, Sunil. So my view, and Sunil has a much more in-depth view. I think of whenever any industry, it's not only the IT industry, Indian IT industry is a good example right now, but many industries have gone through similar points where they have to change their business model. And whenever you think about such industries, think of it like a leaking bucket, right? You are trying to fill up with new AI-based projects, but your base business is leaking big time. And the bigger the leak, the bigger the problem. And that's why what Sunil was saying is that you would rather invest in a pure growth business where the leakage is not happening. There is no existing business. If there is no existing business, there is no leakage. And then the growth is pure growth. Versus when there is existing business to be saved or on which your valuation is built. And if that starts leaking, and that is the problem. So think about the Indian IT industry as a leaking bucket. You have to either stop the leakage or you have to cut the leakage away and start fresh. And it's a big change. And that's where the entire market as well as the industry is, grappling with issues. And this will happen for all the companies. It's not only for the Indian IT industry. The entire SaaS industry in the US software space is also going through the same gyration, same valuation questions. And the most important part to remember is valuation comes from the multiple that you give on the terminal value. If you are not sure about the terminal value, no matter what you do in the near term, is useless for an analyst. So once the terminal value is in doubt or shaken, then all bets are off. It is almost impossible to get that faith back. And that's the problem most of these companies are facing. And in my mind, it is very difficult to get that faith back. Terminal value faith is the most important faith. As of now, it's a leaking bucket. That's the problem. And war, yeah, it's anybody's guess. You can't say much, but we can go on to the next question.
Oh, sir. Thank you. The next question is, what is the one sector you are bullish on in market skepticism?
Suman, your voice cracked a little bit. I could not get the question. Could you please repeat?
Not clearly.
Yeah, go ahead.
Hello. Yes. So the next question was, which is one sector you are bullish on despite current market skepticism?
Fair enough. So, as you can imagine, if
So
somebody,
I'll leave. I need to rush to my next meeting.
perfect. Thank you, Sunil.
Thank you. Thank you.
So, as you can imagine, if somebody is spending money, somebody is receiving the money too, because that spending is happening on something. So, right now, you want to focus on the sectors that are receiving the money. And that again brings us back to AI. And we have talked enough about AI. So, I don't want to talk a lot more. But wherever you are, in general, to think about it is wherever AI, the players in AI who are receiving that spending, who are receiving the revenues, they are, in the short term, they are likely to be the winners. In the long term, everybody will make money if the demand continues. But in the short term, you will see companies come out with good results wherever who is at the receiving end of that Capex. Other sectors apart from AI, where we see a lot of growth are some of the telehealth companies. There are good drone companies, defense companies. There are wonderful companies in the e-commerce space. So there is companies that are providing short-term credit, short-term lending to emerging market countries such as Asia Pacific or Latin America. We are seeing a lot of opportunities over there. So these are all the places where there are good opportunities to be, invested in. So, yeah, go ahead. So, my next question.
So the next question many participants would like to know is, currently you might have seen there's a great boom happening in markets like Taiwan. Are we also adding any such companies, or we already have?
Oh, that's an excellent question. Yes, we got this question a lot. Whether we are invested in Taiwan, we are invested in South Korea. So yes, absolutely, we are more than invested in those countries, and I'll tell you why. So South Korea, the entire stock market boom in South Korea is based on two companies, SK Hynix and Samsung. They command about 45 to 50% of the total market cap of the South Korean market. And the South Korean markets have done well because those two are memory companies. They provide high bandwidth memory, which is a requirement for AI data centers. Without that, you can't build AI server. And it's compared to Micron. is a US-based company. There are only 3 companies in the world who are the largest producers of high bandwidth memory. And you can invest in those 3 companies. If you are invested in South Korea, you have to invest in the 2. We have invested in the 3rd. So yes, we are invested in South Korea through a US competitor or a proxy. And if you see the returns of the South Korean companies versus US companies, they almost track 1:1 for the last 2-3 years, which is when these companies have been in the limelight. So absolutely yes, South Korea we have covered. Taiwan is another market which is purely based on semiconductors. TSMC, Taiwan Semiconductor Manufacturing Company, the largest company in Taiwan, is driving the Taiwanese stock market. We have invested in either customers of TSMC or tool providers to TSMC. And TSMC is listed in the US. We could have invested in it. We chose not to invest because we feel there are better options compared to TSMC. And if you see our software stocks as well as our semiconductor stocks, sorry, not software, they have done much better than TSMC. So yeah, I think through competitors or other companies which are similar to Taiwanese companies, we have invested a lot in those companies. So Taiwan and South Korea, we have covered them very well. You don't need to invest in those 2 countries if you have invested in our portfolio. Go ahead, Sumant. Next question.
The next question is, how should Indian investor position their portfolios if, rupee depreciation continues further?
Yes, I think the global benchmarks, and there are global studies which say that everybody should invest 35% of their exposure, or everybody should have 35% of global exposure outside of their home country. So if you're living in the US, you should invest 35% outside of US. If you're living in India, you should invest 35% of your money outside of India. And there are many studies that have been done. Some of them say 30, some of them say 40. But at an average, everybody agrees that one should have anywhere from 30 to 40% of their money outside of their home country. Simply because it doesn't matter how good a country is doing, how good the GDP of a country is doing. There are things beyond an individual's control which could impact their wealth in a severe manner. If a country does not generate returns, your home country, for 2, 3, 5 years, then your wealth, if you're 100% in that country, is not growing. Versus if you're outside, then it is growing. And then you also get the benefit of a currency hedge. If the currency depreciates like the Indian rupee has done recently, then you get a benefit of a currency hedge also. Overall, the Indian rupee depreciates at the rate of 4% per year. And that has been the case if you look at the last 1 year, 5 year, 15 year, 20, 40, you go all the back to 50 years. If you do an average of the Indian rupee depreciation, it is somewhere in the 4% range. And that is likely to continue because overall India is a capital, we are a current account deficit country, which means we import more than what we export. And that is unlikely to change in the near term. Could it change after 15 years? Sure. But in the next 5 years, I would say difficult, if not impossible, because our primary demand for imports comes from gold, crude oil, and electronics. And in the short term, there is no substitute to any of them domestically. And that's why we do feel that the currency depreciation could continue. Now, will it continue at the same rate? We don't know that. We are not currency experts. But at an average, you should expect a 4% depreciation over a long term. And that's why we do feel it is advisable to diversify globally. And it's not only about currency depreciation, that is one aspect, but even US investors are advised, people living in the diversify, because there could be temporary periods of time where your local assets or local markets don't do well outside of currency. And so even European investors are advised to invest 30 to 40% of their exposure outside of their home country. Next question.
The next question is, Which segments of the land value chain look most attractive today? So, is it semiconductors, cloud infrastructure, software, or services? Did you that get question, sir?
Sorry, I was on mute. Yeah. So the sectors where we are most exposed to are the ones which are on the receiving end of that capex, which means we want to be a receiver of that spend. The spend that Google is doing, Amazon is doing, Microsoft is doing to the tune of 1.1 trillion expected next year. You want to be on the receiving side. And that's where we have positioned our portfolio. Obviously, you cannot have 100% portfolio on the receiving side because at some point in time, these guys will stop spending, or they will reduce their spending, or they will slow down. They might not even reduce. And at that point in time, the market will reverse from spenders to the, from the receivers to the spenders. So you have to be cognizant of that fact. And these companies are generating good returns. Even the spenders, they are generating good returns. They are also in the process of becoming chip manufacturers themselves. So some of the companies like Google and Amazon, they have started manufacturing their own chipsets, and they are going to supply to third parties. So that's another aspect you have to keep in mind, that the spenders may also become the receivers as soon as they start supplying into third party data center providers their own chipsets. And so it's getting more complicated. But yes, overall, we are more exposed to semiconductors, less exposed to software, almost zero exposure to software. IT services, absolutely not, zero exposure. And so I think our portfolio is well placed for the next few years for sure. Obviously, we keep on tweaking as we move forward, but we have no concerns about it. And short-term corrections like what happened yesterday, it happens. We can't control that. And we don't change our strategy based on such one-day corrections. As long as the underlying strategy or the underlying revenues and the underlying demand for our company products remain, these are actually an opportunity to invest. So yeah, I'll pause over here.
Sure. So far we have received all these questions. Some are repetitive ones that we have already answered. If you see any question that I missed, you can answer, or we can close this down. And the participants can write their question on contact us at BayFort.
Okay. Thank you, Suman. One question which was a little bit stock specific, and that's why Suman probably did ask that, is which business is better, like Micron, Marvell, or Amazon, Google, or Nvidia, Broadcom, which has a better growth path? We do believe all of them have a very good growth path. The question is, who is a near-term beneficiary and what you are paying for it. So all the companies that we talked about, Micron, Marvell, Amazon, Google, Microsoft, Nvidia, Broadcom, they are all phenomenal companies right now, doing phenomenal business, growing wonderfully. All of them are worthy of your investment. The question is what you are paying for them right now. And there may be some short-term nuances to, which one will do better in the short term and which one will do slightly less better in the short term. And but short term is 2-3 months. It's not 2 years. So I think all of those businesses are phenomenal businesses. We also keep switching between all these businesses. We have done that in the past. We will continue doing that as and where we feel there is a slight benefit in the next 1 year or 2 years. We keep on switching between these businesses. But they are all phenomenal businesses. They are all likely to grow till AI continues to grow. And as we said, we are in the first 2 years of a 10-year journey. So don't worry about the small correction or a short-term correction that happens in any of these stocks. Most of the times, they are more of a buying opportunity rather than being worried about it. So thanks, Suman. Thanks, Sunil is not here, but we thank him also for joining us for the call. And thank you everyone for taking the time out on a Saturday for this monthly webinar. We hope you have a good rest of the weekend, and we will see you on the next monthly webinar on the first Saturday of next month. Thank you, everyone. Have a nice day. Bye-bye.